Over the last many years, investing in crypto assets, decentralized technologies, and companies that make money off people investing in and speculating on crypto and decentralized technologies have eaten up over 99% of all capital going into the blockchain industry, as well as kind of dominated the minds of investors, entrepreneurs, and builders. Obviously, there's a lot of people in this room, but it's not the case for it. But broadly speaking, that is where people's time and capital is going to today. So we see kind of all of these, big companies and, big funds raising lots and lots of money around kind of this thesis that blockchains help decentralize things, decentralization is good, and we should invest in the future of decentralization is kind of the high level pitch for crypto and decentralized technologies. So what are some of these technologies or assets that have attracted this capital? So we have decentralized finance, decentralized exchanges, decentralized social, NFTs, DAOs, and what pretty much all of these have in common is that there is a token involved at some point, as well as that they laud decentralization as a goal. And if you've been to a crypto or blockchain conference or meetup or listen to a podcast with Chris Dixon or something, what you'll see is that the value of decentralization is very rarely questioned. It's also very rarely explained. What is a very clear answer for why decentralization is good in almost all cases? What we would argue at Unbounded Capital is that the word decentralization is very often just a euphemism for being able to theoretically resist governments, laws, and regulation. So specifically, look at our top example here, the initial coin offering. This was a regulatory arbitrage that still exists a little bit today, but was really had its heyday in 2017 and 2018, where people would raise capital from unaccredited, unregistered investors, depending on what jurisdiction you're in, whether in the United States or abroad, to get around the existing laws and regulations of securities laws. And if you look at what most companies are doing in DeFi today, what you see are companies that are systematically violating the financial regulations of almost every developed country in the world. Whether these companies are doing really great things or producing value, some are for sure, but many have the presumption that the laws will change or the laws will not be able to be enforced against them. And that's a really core theme of the crypto industry, whether or not folks in the industry like to admit it. So there's been a lot of promise with decentralization, and there's been a lot of companies, a lot of protocols that have raised a lot of money. But how have they actually made money? What have they actually done? And here I have the headline of a Helium proposing shifting the entire network to Solana months after the raise. So that ended up happening. This headline's a little bit old, and when they raised this money, how was Helium actually making money? There was a New York Times article that came out a little bit after this slide came out, or the headline in the slide came out. What we saw was that over 99% of their revenue was effectively related to people signing up to speculate and use their tokens or by selling their tokens. And this is kind of the common theme where Helium is one of the most kind of sought after, considered successful crypto projects, but they haven't actually made revenue from being a decentralized technology. They've made money by cashing in on people speculating on the potential future of a decentralized technology. And that's how pretty much everyone in crypto has made money or lost money to date. So we had a similar event last fall, similar slides to what you just saw before. And at that time, we kind of saw, this was in September of 2022. We saw that the decentralization bubble was maybe not popping, but definitely getting a lot smaller. And I think since then, we feel it's pretty clearly popped. Some of the biggest companies that went from zero to crazy multi-billion-dollar valuations in just a number of years are now done. And these are companies that we have been saying very clearly in our letters and our webinars and our materials and our conversations with investors that this is very likely to happen. If your business is predicated on people investing in or trading what are glorified Ponzi schemes, that is not a sustainable business model. So whether you pop and go away due to just old-fashioned fraud like FTX, or your business is like a BlockFi, or and I guess Celsius in some ways, or if your business is kind of just like BlockFi, where if the value of crypto goes down significantly, you're just not going to be able to be solvent. This is not a business that works. It's a business that can make a lot of money in the short term, but it's not a business that I think is going to be able to be around for a while and provide value to people outside of kind of some initial short-term financial gains. So very clearly, this is, not where we think the investment opportunity is. And I think nothing better illustrates this than who has used a decentralized product here today? Raise your hand. What product, Kurt, what product do you use? Yeah. Well, and we'll get into this in a moment, but there's also a difference between I've been using decentralized in the popular parlance, but there's also a technical meaning to decentralization, and pretty much all of our portfolio companies have that, and maybe y'all are, referring to those companies. But most hands did not get raised here, even in a Bitcoin and blockchain type of event, because there's just very, very few products that laud decentralization as their primary value proposition that are really used by many people today. And that's not due to a lack of time. It's not due to a lack of funding. It's been many years and lots of dollars that have gone into this. Yet we still don't really see anything that has really worked. So that is kind of the most bearish and negative you'll hear me for the rest of the day. Because at Unbounded, we do invest in things. And we're actually really bullish on blockchain. We're really bullish on Bitcoin, even if we're extremely skeptical on the vast majority of kind of crypto and blockchain related opportunities that have been around. So what are we bullish on today? It's pretty simple. We like companies with business models we can understand. We like companies that are providing value for a clear set of customers today. And we're leveraging a scalable and efficient blockchain is the only way they can do that, or gives them a huge competitive edge relative to other participants in the market. It's that simple. Unfortunately, still today, there's very few relative to kind of the traditional type of crypto founders that are building there, but that number is growing as we see, and you'll hear from many of the portfolio companies today, as they continue to have success, attract more funding, attract customers, and much of the crypto funding and crypto, talent pool has been, disseminating since the, peak of, crypto a little over a year ago. So today you're going to be hearing from the founders or kind of leadership at DXS, at Haste, at HandCash, at RF Poker, and you're going to be hearing from some other founders as well that aren't currently in the Unbounded Capital portfolio, but we're really big fans of what they're doing in the world. And rather than me talk about what these different companies are doing, I'll let you hear it from the folks themselves. I want to leave you with one last example here before you start getting your free money and we move on to our first founder presentation. So who here has ever tried to read an article on the internet that was sent by someone that was behind a paywall and then gave up on reading the article? Most people. So right now, because companies like HandCash and other micropayment infrastructure providers are not, ubiquitous from e-commerce businesses, from media businesses, for most people today, if someone sends you an article or you read a newsletter that links to a lot of other things and it gets behind a paid wall, your choice is typically it's like on a phone or an iPad, it's not even on your computer. I can't read this article quickly. I can spend 2 to 5 minutes, maybe even more, signing up for a subscription I don't want just to read a single article, or I could not read the article. So even if you have an unlimited budget to be able to read all this stuff, you're just practically not going to be signed up for every paid publication. And due to the friction of what the existing UX is to try to read a simple article behind a subscription paywall of the Wall Street Journal, of the New York Times, the LA Times, you're probably just not going to read the article. But imagine if we had something like this, where with the click of a button, you can pay 10 cents, you can pay 1 cent. Why don't we have that today? Because the vast majority of payments that occur on the internet today occur with credit cards. And credit cards are typically taking something around 25 or 30 cents minimum, plus 2.5%, 3% of the transaction. So basically $1 is the very lowest of the low minimum viable payment That's possible. But if you use a scalable blockchain like Bitcoin SV or the original version of Bitcoin that Kurt spoke about at length, the median transaction fee today is, well under 1/10,000th of a penny. It kind of oscillates between around there and sometimes like 1/70,000th of a penny. So that means you can accept 10,000 payments and you pay 1 cent. So now paying 10 cents allows you to have a 99+% gross margin. That is really big. So this is one example of kind of how that could happen. But you're going to hear from a lot of other great examples today. And then also in terms of just simplicity, most companies, or really the vast majority of funds that are investing in the crypto and blockchain world, there's a lot of complexity. You're investing in SAFs and you're investing in, token warrants and equity plus this and that. We keep it very simple. We invest in the equity of companies primarily via safes, occasionally convertible notes, and sometimes price rounds, investing at the seed stage. That's where we think the opportunity is. Because often, if a company has their own token, especially if they're raising money via that token, that presents a huge conflict of interest between the token holders and the equity holders. So we've seen this time and time again. Ambitious founder wants to start an amazing company, and then they start a token alongside the equity in that business. Well, the equity, how do you realize that? Maybe you raise a huge Series B or Series C, and one of the venture capital firms will cash you out 1 million or 2, but you don't really get your liquidity until you IPO or SPAC or build like a real business. That's really hard to do. But if you have a token, you can just sell that token 6 months, 12 months, 18 months after starting the business. So what do you think founders are going to do when especially you have kind of a hyped up environment? I would argue even with the kind of relatively low price of crypto today, it is still very much in a bubble where the vast majority of market cap for these crypto assets is likely to go away over the coming years. So when you have this environment where if you have a lot of hustle, you have the ability to sell, you can turn that into cashing out millions, tens of millions, sometimes even hundreds of millions of dollars for yourself and your family within a year or two. What do you think is going to win? Building the real business or hyping up the token? Hyping up the token so far has basically always won, which is why that is a red flag for us at Unbounded. And for all the investors in the room, I would encourage you to, be skeptical when you have someone that's trying to build a real business, but then raising money via a token or kind of a token plus equity. And then, as everyone here knows, despite the fact that we're really bullish on scalable blockchains, that is not where most of the money is going into today. If you want to get your startup easily funded, you'll probably in the crypto or blockchain world, building in something in probably DeFi, maybe on like Polygon, Ethereum, that's most likely to get you funded. But is that most likely going to help you achieve success long term? Our view of that is no. When you use blockchains that don't scale and have gotten hundreds, thousands, even in Ethereum's case, millions of times more expensive since the launch, you're maybe making it easier to get some millions in funding now, but you make the unit economics of your business working long term, at least with those infrastructure providers, basically impossible to work. So, by virtue of building on a scalable blockchain today, or not using a blockchain, but thinking about the value of blockchain in a similar way to us, that typically attracts and connects us with long term oriented founders. So, basically, by virtue of avoiding a lot of the popular blockchains and doing your research in DD on what scalable really means, that makes a founder more attractive to us to invest in.